Hi there, welcome to Kneppy Invest. When I first started investing, I was taught and told there was only one way to invest, and that is by far the most popular way to invest today. And I really think it became the most popular way to invest because of Warren Buffett and Charlie Munger. Now, there has been research done that shows this is a really good strategy, and that strategy is buy and hold. So, what you do is you research companies, you look for really good companies, particularly companies at good value, and then you invest in those companies for the long term. So you want to hold those companies as long as the story doesn't significantly change to become negative. And if the story does become negative, that's when you sell. And I suppose the end game is you hold these companies until you die. And I'm not sure that is the best strategy, because what's the point if you don't realize the profits you've made in those companies? Now, a lot of millionaires have been questioned about how did they become rich? And one of the most popular ways to become rich is that sort of strategy. But there is a bit of a disclaimer there. Eventually, you do have to realize your profits. So for instance, Elon Musk, he invested in PayPal, or he created PayPal. I'm not sure exactly what he did. I think it was PayPal, wasn't it? Yeah. And then eventually he realized our profits, and then he invested into some other companies. He did not start Tesla. He invested into Tesla. He saw the opportunity. So I think that is a really good strategy as well. You buy into companies for the short to medium term, and then you realize your profits, and then you look for other opportunities. That is definitely a strategy you could have. But there are many ways to invest. There is not only one way. And that has become apparent to me over the past 5 to 10 years. And that hasn't been really discussed within the investing community, particularly among the experts. I still hear all the time there is only one way to invest, and that is the buy and hold strategy. And I think a lot of these other strategies that don't get talked about will suit a lot of investors out there who are using the buy and hold strategy, but they just don't realize there are other strategies out there that could suit them. And the question is there only one way to invest? Which is actually quite ridiculous, because if there was only one way to invest, that means everyone's doing it. That means you don't have an advantage over everyone else. And if you don't have an advantage over everyone else, just go to ETFs, just get the market average. But then everyone else is just going to get the market average as well. The thing you want to do is find the strategy that suits you so you could beat the market. Because if you can't beat the market, just put your money into an ETF and you're going to have all this free time, extra free time for you. Now, the reason I'm talking about this in today's video is because of a comment that was left in one of my videos about a week ago. And I just want to address that particular question. And that question is, or was, now in saying that, I do think the buy and hold strategy is a really powerful strategy. And if you can just find the good companies and know if they remain good as you hold them, and that is a big question. How do you find these good companies? How do you know they are good companies? And how do you know when they go from being a good company to a bad company? And all companies that have ever existed and will ever exist will go from being good companies to bad companies. History shows us this, that the biggest companies in the world will eventually wither and die. That is something that's been proven through time and won't change. The saying that this time is different is completely wrong. I have no doubt that Amazon, Apple will eventually wither and die, and you don't want to be holding those companies once they turn the corner, and they will eventually turn the corner. So the question becomes, when do you know they go from being good to bad? It's a significant question, and probably the most important question for buy and hold investors. I finished watching season 4 of Cobra Kai. And if you don't know what Cobra Kai is, it is the sequel to the Karate Kid movies, with all the same actors, all the same characters, mostly. We don't have Mr. Miyagi in this TV series because he unfortunately did pass away. But we have Johnny Lawrence, we have Daniel as the main characters driving this TV show. In fact, the show itself focuses mostly on Johnny Lawrence, And if you do watch a show, he's a guy you really are rooting for, even though in the movie he was considered the bad guy. Anyway, Robbie Keane is the son of Johnny Lawrence. And in this episode I was watching yesterday, Robbie Keane said something that was quite enlightening and very relevant for investing. And he stated in this episode, everybody thinks their way is the best. Truth is, it doesn't matter which way you fight as long as it works. So let's just turn that around as an investing quote. Everybody thinks their way is the best. Truth is, it doesn't matter which way you invest as long as it works. And this is the reason why I don't believe there is only one way to invest. I don't believe the buy and hold strategy is the only way. I think you have to find the strategy that works for you and use that strategy. It might take you a while to find the strategy that works for you. It has taken me over 10 years to find strategies that work for me, and I still have yet to find the perfect strategy. My strategies are still evolving through time. And I think it is a shame for a lot of these experts who stick solid to the same strategy because they were told, probably in their young days, it is the only way to invest. And they could become better investors if they evolve their strategies. And I'm thinking of quite a few experts, but I won't say their name here. I could actually think of these guys being much better investors if they just become open-minded. Another favorite quote of mine, and it's not from Robbie Keane of the Cobra Kai, I just forgot to delete that, and I can't be bothered getting out of virtual background in Zoom. Now, this original quote has been attributed to Buddha, but I believe that is fake. There's no proof that he actually said this. Anyway, the original quote states, doubt everything, find your own light. It is a really powerful thought to have in your mind as you go through life. Just don't believe everything you read on Facebook. There is a good chance it might be absolutely wrong. And the amount of times someone has posted something on Facebook, and I've just done a little bit of research to show that is absolutely false. In fact, for instance, someone put on Facebook that microwaves are banned in Russia. This was like 5 or 6 years ago because of some reason. A simple bit of research shows that microwaves are not banned in Russia. Someone else stated that KFC or Kentucky Fried Chicken changed the name to KFC, just the initials, the anagram, whatever it's called, because there is no chicken in their products. And a simple bit of research would show that is absolutely false. So many people believe everything they read or hear, and you have to question or doubt everything. Find your own light, just tells you. Question, doubt, find what is true for you, and if you can do that, you'll become a much better person, a much better investor over the long term. Now, I'm just going to go through some of investing strategies and investing concepts over the next 2 slides. So the first one is buy and hold. Now, this is probably the most popular sort of strategy or investing strategy. You buy those companies you want to own for the long term and just hold them as long as possible or until the story changes. I still do this sort of strategy, but I am evolving this strategy. I'm using other strategies to really develop a unique strategy for myself. And that's the main thing. I want to develop a unique strategy for me that works for me. Another one is dollar cost averaging. I don't do this at all. So, for instance, if you get $2,000 every fortnight through your pay, and then you spend money on rent, mortgage, food, and then you're left over with $500, you immediately invest that $500. You don't care about where the stock market is, that sort of thing. I don't really like that sort of strategy because I think there are good times to invest in the market and there are bad times to invest in the market. Now, the reason why this sort of strategy is touted is because of the belief that you can't time the market. Now, in a sense, that is right. You can't time the exact top, you can't time the exact bottom, but you can time the market in terms of if we move into a bear market, it will become fairly obvious. If we move into a bull market, it will become fairly obvious when it switches. And you do use technical analysis for that. So those who are saying you can't time the market don't have an understanding of technical analysis. And I think that is wrong. I think all investors should have at least a basic understanding of technical analysis and at least a basic understanding of fundamental analysis. Now, there's also passive versus active. Passive is where you buy into companies, sort of like the buy and hold, and you don't trade, very rarely trade. While active, and I'm tending more towards active right now, is where you take advantage of opportunities. You look for companies that have good positive momentum behind them. Even when the market is a little bit bearish, you still have these companies that release some good news flow and whose share price will go up. And you take advantage of that. And I'm finding being a little bit more active than passive, I am actually increasing my returns, my annual returns. So this just shows you that sometimes a passive buy and hold strategy may not work for you, and it's not working for me when I compare it to returns I'm getting using a more active strategy. When I first started investing, I did not look at charts at all. I just researched the company, looked at the valuation of the company in terms of markup, and thought this is good value or bad value or fair value based off what the share price is doing. I didn't look at the charts where the share price has been going in the past. And a lot of times you can see where the share price is right now, where it has been going over the past few months, and get a good determination or probability about where the share price might go in the next few months. So a lot of these people who don't believe technical analysis works will probably say that's a bunch of hogwash. But short to medium term movements in share price is all determined by psychology of people. And psychology is fairly easy to understand when you put some research into it. So this is why technical analysis does work, because it's based off psychology and probability. And when you combine probability and psychology, you get a good determination about where share price of a company might go in the future. Not will go, but might go. Value or deep value. Now, I actually really like these sort of strategies. Now, what's the difference between value and growth? Because in my opinion, there's not much difference between value and growth, because all investing is looking for value. If you're investing in a company right now and you don't think it's value, why are you investing in it? So all investors are looking for value. That is an absolute truth in my opinion. Now, when you're talking about deep value, that's a little bit different. You're looking at companies whose share price are well below where they should be. Now, there could be some reasons behind that, but there are some investors out there who do use this strategy, looking for those companies who are up deep value. Now, I think this strategy would really work during the depths of a bear market, when a lot of companies' value is well below the assets of the company that they do hold. But the then question is, will that company be an ongoing business in the future? So those sort of questions have to be looked at. And I think at times, this strategy would be a really good strategy to employ, the deep value strategy. The sort of investors I'm looking at here are like Tobias Carlyle. What's his strategy? He uses the acquires multiple. So just Google him. I actually do like him. He gets onto a lot of podcasts. Originally, he's Australian, but he does use this deep value mindset. Warren Buffett, particularly in the past, has used this mindset, this strategy as well. So I think it's a very valid strategy at certain times, certain points of the cycle. Income investing is an absolute legitimate strategy to use, particularly if you are in retirement or close to retirement. I'm not using a strategy right now, but eventually I will probably pivot towards this strategy in the future when I want to have a steady income stream coming into my account. Now, right now, I don't look at the dividend yield of a company. If the company I invest in has a good dividend yield, that's just a nice surprising benefit. And when I get the dividend, that's a nice surprising, but it's not the end all be all when I take an investment in a company. It's just a nice little benefit. But I think over time, my thinking in regards to income investing will change. Now, when it comes to contrarian, this is looking for those companies within certain sectors or individual companies that are unloved by the market. And I have used this strategy in the past, particularly around commodity stocks. And I find the commodity cycle is really predictable. And if you can take advantage of that predictability, you can actually do really well investing in miners. I have combined this contrarian approach with technical analysis. What I do is I look at the price of commodities, and when I do see it reach a bottom and starting to move up, I wait for the commodity to move in an uptrend. Then I look for companies that mine that particular commodity, and that's when I might take a position in those companies. This works or has worked really well over the last 5 years for me and is a definite investing strategy. And I just use it in combination with other strategies. Indexing is, I think, a legitimate strategy for those who just want to remain passive, don't want to spend any time researching companies, just find some good ETFs to invest in for the long term. I think you go to sleep good at night knowing you'll get the average market returns, maybe even better than market returns if you are able to invest in some weird ETFs, some thematic ETFs at that. The other reason indexing is really good is you can buy, say, if you want to invest in India, you don't have to find any Indian companies, don't have to do any research. You just buy an Indian ETF or maybe a Russian ETF in about a year's time when that market hits a bottom or something like that. The next one is small cap. I actually am really attracted to small cap companies. And the reason I'm attracted to small cap companies and a few other people I follow on Twitter and also on podcasts is because large cap companies are really covered. But small cap companies, or some small cap companies, are not covered at all. And that's where you do find opportunity to discover companies that are really undervalued. I have done this time and time again, finding profitable companies that are really undervalued. And that strategy has worked really well for me. But in saying that, you have to be aware that a lot of times these companies can be quite volatile in their share price. The share price could fall 10% because 200 shares were sold during the day. So if you don't like volatility, potentially small cap area is not for you. Socially responsible investing. This has become quite popular in recent years and will become increasingly possible. Increasingly, what's the word I'm looking for? Increasingly popular over the next 5, 10, 20 years. We want to invest in companies that are socially and environmentally responsible. This is a no-brainer in the future. The question then becomes, how do you determine whether a company is socially and environmentally responsible? Just because they say they are doesn't mean they are. And I've actually heard some ethical ETF management people talk, and I actually find what they do sometimes is highly unethical. So you do have to wonder if these ethical funds are highly unethical. And that's just my opinion on what some of the things they do. I won't talk about here. You do have to question how they determine whether any companies they hold in their ETF are themselves socially and environmentally responsible. And the last thing is you can do a combination of all these different strategies, these different things in your own strategy. But the key is finding a strategy that works for you. It could take many, many years to find that particular strategy that works for you. Just don't believe that there is only one way to invest out there. There are many ways to invest. That's all I have for this video on ways to invest in stocks. If you want me to expand on any of these ways you can invest, just leave a comment in the comment section. I am thinking about doing a dedicated video on each single way you can invest. So buy and hold, technical analysis, small cap investing, socially responsible investing. If you want me to do a dedicated video on any strategy, just leave in the comment section of this video. If you have any questions, I'd love to hear it. If you have any thoughts, I'd love to hear it, particularly if your thoughts are counter to mine. If you do think buy and hold strategy is the only way to invest, I'd love to hear your opinions on why. Particularly, I'd like to hear or see any research, non-biased research, that actually proves without doubt that the buy and hold strategy absolutely is the only way to invest. I have not found that sort of research just yet. Now, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.